We often hear about the staggering debts of governments, tens of trillions of dollars accumulated over decades of deficit spending. But another debt crisis is quietly brewing. And this time, it's not in Washington. It's right in your wallet and mine. Consumer debt. Unlike government debt, which can, in theory, be covered by printing more money, consumer debt is grounded in something far more fragile: our income and our ability to repay. It's the sum total of credit cards, auto loans, mortgages, student loans, and increasingly buy now pay later schemes. As of Q1 2025, total U.S. household debt has reached an unprecedented $18.2 trillion. It's no longer just a personal finance issue. It's a national trend. So why are people borrowing more than ever? Sometimes it's for long-term investments like a home or college tuition. But increasingly, people are borrowing just to get by, covering groceries, utility bills, and healthcare costs. In a world where the cost of living rises faster than wages, debt becomes a temporary lifeline until it pulls you under. Take credit cards, for example. The average interest rate now exceeds 20% per year. If you don't pay off your balance in full each month, you start accruing interest, and the debt can quickly spiral out of control. As of early 2025, Americans owe over $1.88 trillion on their credit cards, up more than 50% from pandemic lows. Over half of cardholders carry a balance from month to month. And it's not just bank-issued cards. Retail credit cards, from big box stores, fashion brands, or even local chains, often carry even higher rates, sometimes up to 36%. They lure you in with discounts at checkout, but if you don't pay on time, those discounts can come at a steep price. Another fast-growing trend is buy now, pay later. On the surface, it seems harmless. Zero interest, instant approval, and no hard credit checks. But that ease comes with risk. Many consumers now juggle multiple installment plans across different platforms, without a clear idea of how much they actually owe. Unlike credit cards or traditional loans, most BNPL services don't report to credit bureaus, making it difficult to track total exposure. And when you miss a payment, late fees can be significant, and your debt may be sent to collections just like any other loan. Then there's the biggest debt most people will ever take on: the mortgage. Americans now owe over $12.8 trillion across 85 million home loans. The average mortgage balance is just under $150,000, while the median home price has surpassed $500,000, more than double what it was a decade ago. The housing market frenzy during the pandemic was fueled by record low interest rates. But in 2025, with rates hovering around 7%, affordability has plummeted. Inventory is rising, and for the first time since 2008, in many markets, sellers outnumber buyers. While most homeowners are locked into low rates and have built up equity, the cracks are forming. Mortgage delinquencies and foreclosures are rising, still modest, but worth watching closely. And then there's student debt, now totaling nearly $1.88 trillion. The average federal borrower owes more than $38,000. For many, the bill arrives before their first paycheck and stays with them well into middle age. During the pandemic, payments were paused. But now, collections have resumed, and over 20% of borrowers are 90+ days past due, a record high. And unlike most debts, student loans are notoriously difficult to discharge in bankruptcy. All this adds up to a troubling reality. Americans are spending over $560 billion a year just on interest payments. That's not principal, just interest. In other words, millions of hours of labor are being devoted solely to servicing past debts, not building future wealth. And when such a large share of income goes toward debt repayment, consumer spending, the engine of the U.S. economy, slows. Retail sales have plateaued, auto sales are declining, and the housing market is cooling in key cities. Meanwhile, delinquencies are rising across all major forms of debt. As defaults increase, lenders tighten standards. Credit becomes harder to access. Interest rates go up. And the cycle of credit tightening begins, dragging down both consumers and the broader economy. To be clear, it's not all doom and gloom. Many households have strong balance sheets, and some are actively reducing their debt. The banking system is more resilient today than in 2008. But if high rates persist and the labor market weakens, debt will continue to drag on the economy. quietly but forcefully. This is not a sudden collapse. It's a slow squeeze, a creeping crisis that's easy to ignore until it's too late.